Hello, and welcome to the Moss Adams Virtual 2023 Building Opportunity Conference. We are pleased that you've all joined us today. And before we begin, I'm going to play a housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, this is the 4th of 5 sessions in our 2023 Building Opportunity Conference. Today's topic is the Capital Markets Update. If you missed any of the sessions, you can view them on demand at the link provided in your console. And now I would like to introduce today's moderator, Chris Paris. Chris is a tax partner and has over 20 years of experience in public accounting. He has extensive fund experience, including real estate funds, private equity funds, hedge funds, and other types of alternative investments, and advises on matters related to taxation and organizational structure. Chris, the floor is yours.
Thank you, Amy, and thank you everyone for joining us today. We've got a really great panel today with our capital markets update. We're going to go ahead and kick it off with some introductions on the panelists. So Bob, we'll go ahead and start with you.
Thanks, Chris. My name is Bob Graham with Rockwood Capital. We are a real estate investment management firm. We have an equity and a credit side of our business. We have roughly $14 billion of capital, debt and equity under management. We invest up and down the capital stack across geographies and product types.
Thanks, Bob. Jeff.
Yeah, hi, everybody. Thrilled to be here. Jeff Burns. I'm with Walker & Dunlop, based in here in Walnut Creek is our office. We're headquartered back in Bethesda, Maryland. We're the largest apartment lender in the country and the largest agency lender. We have direct licenses with Fannie Mae, Freddie Mac, and HUD to originate multifamily mortgages. In addition to that, we'll source debt through life insurance companies and debt funds and other alternative sources of capital. So thrilled to be here.
Thank you, Jeff. And Stanley.
Well, thanks, Chris. I appreciate this. Stan Iezman, I'm the CEO and chairman of American Realty Advisors. We're a private equity real estate firm with $12.5 billion of assets under management. The distinguishing factor between Bob and I are that our funds, we have 2 funds, an open-end core fund and an open-end value fund. And between the 2 funds, we have over 620 investors that are investing in the strategies that we are investing through, which is as similar to Bob going up and down the capital stack, where we will do direct equity, JV equity, pref equity, and as well debt in certain contexts. So we're open end as opposed to closed end.
Thank you, Stan. And we're going to go ahead and get into some questions here with the panel, you guys. But before we do that, we're going to start with our first polling question. So, Amy?
All right. Thank you, Chris. So the first of 4 polling questions is, what real estate sector do you operate in? And your options are residential, industrial, office, multiple, other, or not applicable. And the polling questions are located right on the slide, so please make sure you have those open. And then you're going to click the button next to the answer you choose, and then make sure to hit submit so it tracks your CPE. All right, we'll leave this up another 5 seconds while everyone figures out how to submit the response. And here are the results.
Great. Thank you. That helps give us some insight into the audience and your guys' kind of role in the industry. So that's helpful. Thank you. So for the panel, we were going to start off with just, kind of an open-ended, wanted to get your perspective just in terms of a general observation on the market. We had the 10-year Treasury just inch above 5% for the first time in 16 years. And obviously depends on property type, geographic location, et cetera. But as you guys are assessing your short-term business plans, which market drivers are really kind of affecting your decision with respect to short-term business planning?
Okay. Do you want me to take a swing at that question?
Sure, Bob, we can start with you. That'd be great. Okay.
So there's the capital markets, and then there's the fundamentals markets, by property sector. And basically, multifamilies have been more of a favored asset class. It benefits from agency financing. Industrials had tailwinds. Retail, it depends what type of retail. It's done pretty well, particularly the convenience retail. Hospitality's benefited from the post-pandemic surge. And then you have the alternatives like data centers and everybody using AI, and that's had tailwinds as well. Offices is obviously had headwinds, which you've all read about. I think when you talk about what are your views on the market, I think you have to distinguish between the public and the private debt and equity markets. So if you take a look at the public and private debt markets, they already repriced with the run-up of interest rates. And there's opportunity there if you have that flexibility of mandate. If you look at the public equity market, i.e. the REITs, they have repriced, and you can buy public REITs at higher cap rates, if you will, better valuations than you can in the private market at present. And the fourth quadrant, the private real estate equity is going through a price adjustment phase, which has really been driven by sort of a combination of rising interest rates, rising discount rates, and in some sectors, softening fundamentals. So it's very idiosyncratic by location and property type. You've all read about the Sunbelt markets. I think they are benefiting. You have urban and suburban locations. First-ring suburbs, the urban locations, like take, for example, Summit, New Jersey, or West Palm Beach, they're doing very well, even in the office market. You come to San Francisco, and the entire market is soft because of the nature of the employment drivers in this market. Having said that, that's the office market. The apartment market's actually doing pretty well, depending on submarket. So it really varies considerably by location and property type is sort of the quick answer.
I think that the primary challenge that we're all facing, as Bob alluded to, is the fact that we have a balance sheet problem. We have a capital structure problem that exists in the marketplace today that we're trying to work through. I mean, we have lived through, if you think about this, a secular shift starting in 1981 that is now becoming cyclical, where we had interest rates dropping from a high of a federal funds rate of 20 in 1981 to where we are today. And this has given a great solace to real estate investors, because if you were able to buy with very cheap interest rates, you were able to generate an overall return. And this is actually crossed the wall into private equity. Private equity returns historically over the last 13, 14 years have been very high because of very low interest rates. And I think what has now happened is that the Fed has basically said, we're not going to continue to support this asset bubble inflationary environment. And what we're going to do is we're going to short circuit this by dropping interest or increasing interest rates in an effort to try and take out the frothiness that exists. Whether that's the right thing to do or not, we can debate. But the fact is that it's challenging all of us in the industry, which, as Bob intimated, now suggests that it used to be TINA. There is no other alternative other than real estate. Now we have TERRA. There are reasonable alternatives. Those other reasonable alternatives are debt. So I have friends of mine, family members, who call me up and say, why should I ever buy real estate when I can get a 5% return in a treasury? Or alternatively, I can buy a 20-year GO yielding a tax-adjusted return at about 8.25%. So that's what we're trying to compete with, because there are other alternatives that are out there in the real estate market, which drives the whole conversation that we're going to have today.
Yeah, I mean, I agree with both what Stan and Bob have to say. Certainly even in the apartment world, we're dealing, the issues are less fundamentals and more broken capital stacks. Especially deals that were getting done, call it 2018, 2019, and into the pandemic years, where cap rates were really low. Interest rates were really low, but there was a continued chase for leverage. And so a lot of borrowers took out 2 or 3 year term debt fund deals that had a really low debt yield going in. And even if they've been able to execute on their business plan, those loans are starting to mature. And most of these properties now, because of where rates are today, they can't even qualify for their extensions. And so we're spending a lot of our time these days trying to solve for a broken capital stack. And that's bringing in fresh, new, longer term financing. It's bringing in preferred equity. It's bringing in even new JV equity. And trying to fit the pieces of the puzzle together to help clients get through this. And as Stan said, the cyclical nature of our business, I think, gives people comfort that this too shall pass. And we will just need to get to a better day ahead. And it's solving to how do I get from today to that better time ahead, rather than selling an asset in this environment. Certainly in multifamily, we've seen very, very limited institutional sales in 2023 because sellers don't want to sell unless they have to sell.
Yeah, thanks, you guys. All really great comments. So touching on that kind of transaction activity comment that you just made, Jeff, as you guys look out to Q1 and Q2 and maybe even Q3 of 2024, do you guys expect to make any type of significant investments?
If I could just stop for a minute here and just go back to what Bob said before about the public market and the private market. The public market pricing much more instantaneous than the private market. And I just want to reflect on the fact that if you look at office implied cap rates with regard to in the public market today, it's about an 8.3 implied cap rate. If you look at the Odyssey index, which is the proxy for, I think, private real estate for the moment, the Odyssey valuation rate today is 5.52%. So we have a 300 basis point difference between public and private market expectations. And when you're sitting here thinking about, as Jeff was just talking about, the notion that I'm not going to sell if I don't have to, that has to presume certain expectations in capital market growth and what the cost of debt is going to be in the marketplace, which drives the answer in some regards to your next question. So and I'll let Bob, I'll pivot to Bob on this one.
Okay, thanks, Dan. So first of all, I think you have to distinguish between short-term and long-term. Short-term, there's clearly some issues with distressed owners, distressed assets. Having said that, you can be actionable. We are at present by probably a factor of 10 more active on the credit side right now, where you're getting equity-like yields on the credit side of the business, and not as actionable on equity because it's still in the private market repricing, as I covered. The other issue is negative leverage. If you can get on a publicly traded apartment REIT a 4.5% dividend, which you can today, you cannot get at positive leverage, so you're not getting that sort of dividend on private real estate. So therein lies the challenge. With regard to credit, there's sort of a number of different ways you can play in that. You can buy first mortgages, you can buy distressed debt, which is really just an equity substitute, or you can be part of originations and refinancings. We most recently closed on a refinancing where the borrower needed to delever off of a construction loan, and that part of the capital stack is generating 10.5 to 11% returns. If you want to get a little bit more, take a little bit more risk and go further up in the capital stack, say up to 80% on today's value, real value, I think you're going to find that the pref equity returns are another 100 to 200 basis points above that. So I think there's going to be a lot of opportunity in 24, and it sort of gets into your risk tolerance in time. If you have a lot of risk tolerance, you can go buy distressed debt on office. If you want to take a little bit less risk, you can do perhaps B pieces at comfortable attachment points on apartments where the valuations are lower, the documents are better, and you really, frankly, have a much more secure investment and don't, obviously have the downside that you have with common equity or leveraged equity.
I was going to say that
I think obviously as a lender, it's been really tough to get deals done. Just when you think you've finally gotten a borrower to get to a point where they capitulate a little bit and recognize where rates are and the deal still kind of works, treasuries run another 20 basis points on you, and then you're upside down again. So we would love to get more money out the first half of next year. I just think, in speaking with my clients and their investment plans, they all have money. I mean, a lot of my clients are private REITs, closed-end fund type borrowers. They all have money that fortunately they raised before. It's gotten a lot tougher, and I know we're probably going to talk about this more, but it's gotten a lot tougher to raise money these days, in part because of the alternative investments both Stan and Bob were talking about that you can go into. But they'd like to get money out. Everybody's expecting, from my client's perspective, that the first half of 24 is going to be very similar to the second half of 23 in terms of investment activity.
Just as for background purposes, as Bob was talking about, there's much more of a focus on debt right now. I think Steve Schwartzman said the other day, who's the CEO of Blackstone, that why would he do anything if he can get a 13% yield on a credit instrument today? There are over 2,000 fundraisers going on right now, the majority of which is in opportunistic debt or opportunity-driven rescue capital funds. So there's a lot, and I think that the number that is being raised is over $560 billion. So this is a crowded space with a lot of people looking for capital, looking for the opportunities that are out there. Whether there are opportunities today remains to be seen, and I'm sure we'll be able to talk about it. But being specific about what our plans are for the next 12 months, 6 to 12 months, I'm going to say that we're managing our balance sheet. The biggest issue that we have as an investor in an open-end fund is managing the redemption queue that exists, which is fairly healthy for most of the funds that are out there. There's certain funds in the Odyssey Index where No names will be mentioned, that have over 50% of their total NAV that is in the investment queue waiting to get out. The majority of us are at about 11%. So we're managing. So the goal is to manage investor expectations, manage the balance sheet, and be able to figure out how we're going to deal with debt maturities as they come up, being able to pay that out. And in addition, being able to deal with the rebalancing obligations that are going to be required in order to be able to go forward with transactions. Or alternatively, make fundamental decisions of whether you're going to keep the asset and basically turn it over to the lender. And I think for those of us who own office, that is the existential risk and challenge that we're all sitting down and talking about every day. Do you put more capital into office? And do you otherwise just give a put back to the bank? Sorry, Jeff, you're the lender on this.
Hey, Stan, let me sort of just comment. So you said there's this big wall of capital that's either has been raised or will be raised, but there's also a big equity need in whether it's remargining or what have you. Bank originations are down. I think you've all been reading about that. Insurance originations are down. CMBS and agency, that market is if you want to, the cost of the capital, there's liquidity, but the cost of the capital is high. And then same thing with the debt funds, although some of them have been crimped by their credit facilities, which are tied to banks. So I think there's going to be a big equity need, or capital need, I'll just call it, that is in some ways going to work out over the next 3 or 4 years, because you have a lot of debt expiries, you have leases expiring in office, and frankly, there's a big value reset. So some of those queues, by the way, may go down in the Odyssey funds as valuations drop.
By definition, the rebalancing on the part of the pension plans, our institutional investors, is going to be self-satisfied by reducing values of office buildings, which is really the big issue of getting to certainty and predictability in the valuation metric. Clients say, when are people going to go back and start investing again? As Jeff was mentioning, there's not a lot of money being raised right now, certainly not in the open-end fund universe. It's going to come when everybody feels comfortable that there's certainty and predictability with regard to the valuation metrics that are being used.
Stan, we have we closed end and we have one open-end vehicle in the apartment space. And the issue is if the look-through is the public apartment REIT market, they're looking and saying, well, valuations are likely to fall in the private market. So even though you've had wonderful performance or what have you, we're going to wait, which is a rational thing to do. I would do the same thing as an investor until valuations settle.
Right. It's hard for a new investor to come in and pay $10 and then turn around and the next day get a valuation statement that's $9. Doesn't work very well. There's political risk for the decision maker in doing that.
We've already touched on this next question a little bit, you guys, indirectly, but just, the apparent disconnect between interest rates, cap rates, property valuations. How do you see this process evolving? Are you seeing any particular type of deal getting done? Jeff, I know you had mentioned kind of the pref equity coming in, some kind of restructure with a joint venture type arrangement. And any comments on the types of deals that you're actually seeing get done in this environment?
Yeah, sure. I'll take an initial stab at that. Look, cap rates have been slowly chasing interest rates through this, right? But there's been a lag, and I think it was Stan that mentioned, or it could have been Bob, but the negative leverage situation is just really tough. If you're buying an asset and you've got a business plan for it, a year ago it was kind of like, the brokers were out there selling, the fact that, you're 100 basis points negative on your leverage day one, but you're going to be positive 150 basis points by year 3. Well, I don't think investment committees are buying that argument from their acquisition guys anymore. And because you have seen a little bit of softening in rents in a lot of markets. And so to make the argument that, that you can get to positive leverage in 24 to 36 months just isn't there right now. And then the volatility, I think, has made it really hard for sellers to capitulate and move, sell a deal at a, where the market was kind of a high 3, low 4 in the apartment world for a long time, but you could borrow at 3. And so now it's just the volatility is really hindering the ability for the market to settle in and readjust. It's got to readjust, and it is on some deals, but it's just been a real challenge. And property valuation, that's another thing that we're telling our clients that might have a maturity in mid 2024, and they've got a 3.5% loan, and they want to hang on to that loan to the last day they can. But we're telling them, you start seeing some of these deals trade at a high 5 cap, mid 5 cap, 6% cap rate. When you go to refi, that's going to have a real impact now, because there's real live comps that are going to impact your value on your refinance.
I don't think that there's capitulation yet on the part of sellers, owners, in connection with valuations. The mark-to-market adjustment that is required to be made has broad political, social, and economic implications if in fact that was done tomorrow morning. And I just want to caution, because it's real easy to say, and I joke about this with our investment committee, that negative leverage is easily resolved when you mark to market to the appropriate number, because it becomes positive leverage when you go down by 60%. But nobody wants to hear that, and that's not going to transact in the marketplace today, because that capitulation level hasn't been there. Whether there should be capitulation or not remains to be seen. But I think that Bob's comment is the appropriate one, that capital that looks out in the future and realizes what a buying opportunity this is going to be doubling down in buying real estate at new bases that are going to be generational in nature, in my opinion. I'm going to leave office for the moment aside on that, but I will say for every other asset class that is out there in the institutional world.
Yes, Stan, I have the privilege of staying in San Francisco. I can tell you there's a capitulation going on here in the office sector. And I think you're going to see some of that in New York and elsewhere. So the office sector is sort of kind of like the new mall sector, in that it's has a very negative sentiment. There's virtually no liquidity. And so you have to almost underwrite office assets on a leveraged basis, or the sellers providing financing in order to get transactions to across the goal line.
You know what's rather interesting when you look at the data that is out there? Office seeking employment, which is office jobs, are increasing at very high numbers. So if you look at San Francisco, because Bob, I have property there, Bob, I don't know if you've got stuff there, but I've got some of the best buildings in downtown San Francisco. And if you look at the employment numbers and you look at the office jobs, they're off the charts. They're above pre-pandemic levels. Yet utilization and demand is down significantly. So this work from home dynamic is really crucial. And the issue is, it's just not a real estate industry issue. This is a political issue that we need our leaders of our governments, the federal, state, and local governments, to really think about and focus on. If you really step back for a moment, why are we not requiring every government agency to require all their workers to be at the office? Your center cities are going to die, and to the extent that we do not find a way to rebalance what is going on in our downtowns. And so all the hundreds of billions of dollars that we have paid to put in mass transit systems, which are basically going to your center cities in blue cities like Los Angeles, San Francisco, Seattle, Portland, Chicago, et cetera, these cities are going to die, and they're going to lose their municipal funding because they're not going to get enough taxes until we figure out a way to turn this around. So this is a broad issue that is going to go on.
Stan, it's a really good point, and it struck me. I didn't realize the extent to which our state and local governments have not required their workers to go back to work. I was in Sacramento last week touring some new properties, and the guy I was touring around with said, look at these beautiful office buildings here. Brand new, beautiful office buildings downtown Sacramento. And I said, oh, those, what's the story on those? And he said, those are all built by the state of California, brand new offices for, tens of thousands of workers, and they're sitting there empty because they won't require the workers to go back to work. So to your point, and all the retail and all the coffee shops and restaurants and everything around them are shut down. And that blew me away. I didn't realize the extent to that was happening.
So let me give you some perspective. They're not talking about return to office in Seoul, Korea. It's being discussed in San Francisco. So it sort of gets into who has the leverage, the employer or the employee. And so what's happening is we're creating jobs, but they're not ending up in traditional offices or they're hot desking. And there's an aversion to commuting, which is sort of one of the big issues for some of these urban markets. I think Tim Cook of Apple said it right, though. This is a big social experiment, and no one really knows the outcome. If the underlying employers, the Apples, the Googles, et cetera, don't know exactly what the new normal is for work day life, then I think it's going to be difficult for the underlying landlords to know what the future looks like.
Going back to your original question on valuations, I just want to touch upon it for a moment. It's an important, just to sort of put it out there. We don't do our own valuations. We don't have our fingerprints on them. We use external sources for that, which are basically a valuation manager. Their name is probably one of the largest in the country that does this. But the challenge with valuations, it's like driving backwards down the street in your rearview mirror, because you're looking at yesterday's data and yesterday's information in order to determine what today looks like, and it's always wrong. So in a downward market, it's always wrong. In an upward market, it's always wrong. You're always looking backwards. And unfortunately, what we do is that we become naive to the idea that those numbers they represent something. Because if you look, I just mentioned the forward curve for the 10-year. If you go out and look at the forward curve, the Chatham forward curve for the 10-year Treasury, it's up in the next 3, 4, 5 years. Is that right? It's always wrong. So the question is that does it really mean anything? It's just a guidepost that you need to think about.
Thanks, Dan. Before we move on, you guys, we're going to hit one more polling question here. So, Amy.
All right. So the second polling question is, what do you expect to see in the next 12 months with interest rates? And your options are A, increase, B, no change, or C, decrease. This one should go pretty quickly. And just a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. All right, most have responded, so I'll give it a few seconds and then we'll close this one out. And here are the results.
Thank you. Interesting. So for the next question, you guys, just wanted to touch on the fundraising environment a little bit. What's the current state of the market for raising equity? Is there an appetite or is there demand from capital sources? Are there other alternative sources of capital that you're seeing play a more prominent role in today's environment? Just any kind of commentary you have with respect to the fundraising environment on equity.
So maybe I'll take a stab at that. So you have project level fundraising, and then you have, I'll call it fund, at a much larger level. So I'm going to focus on the latter, the funds. And you have open-end and closed-end fund structures. As Stan covered, the open end, I think, are difficult with the exception of maybe credit. And with regard to the closed end, it's really sort of barbelled into closed end credit because core is difficult to raise. And then on the other end of the spectrum is really opportunistic structure. So in some ways, investors are barbelling their strategy.
Yeah, I don't think that, I mean, very candidly, and as Bob was saying, and to be totally open kimono here, is that fundraising in the closed-end fund universe is happening at the margins. It's not a lot. And that's just simply because the valuation metrics in a closed-end fund where you're buying into existing assets is very hard. I think it's much easier in a closed-end fund where you're going in with new valuation metrics. And I would expect to see that. Where we are seeing, though, is there's a bifurcation. It's interesting to see that foreign capital is coming into the United States, I think, in a bigger way than domestic capital is at the moment into real estate. They're looking, if they're going in at all, it's in the debt space, as Bob was suggesting.
Yeah, and I would say, just speaking, more like on kind of the private real estate equity, project-based, your classic kind of large syndicator. That's gotten tougher to raise on fresh equity on new deals because sellers haven't capitulated yet, and so the returns compared to alternative investments these investors can go into that are much more liquid is making it very difficult. And then on the flip side, folks that would be doing a 1031 exchange, there's no product to go into. So guys that would exchange their private equity into a new deal that would sell, maybe they've got a 70s vintage product and they'd like to sell that and go into a 2000 vintage product. There's just not enough deal flow out there where they feel safe that they won't get hit with a big tax hit. So it's challenging that side of the market too right now.
Yeah, there's a lot of discussion of, quote, rescue capital. And, I think the issue there is, particularly, let's just take multifamily or industrial, two asset classes that generally have lower equity yields, unlevered equity yields. You can't current pay that on mezz. Like you can't charge, in many instances, it doesn't support a 10, 11, 12% current pay on mezz. So you end up going to a pref structure and having a soft pay. So you may have a current 6 or 8, and then the difference is made up in a soft pay that's paid at a capital event, sale, refinancing, what have you. So that's one of the things we're seeing right now is there's sort of liquidity, but there's the pricing of that liquidity. The investors or the owners don't want it in many instances unless they have to take it.
Yeah. One of the challenges of using pref equity, and I just caution everybody about this. It's a great tool, but you have to have enough capital to be able to service the senior to the extent that there's an issue coming in. That's number one. And you have to have a mechanism to be able to get control of the property to the extent that the operator is not going to fund any capital calls that may be necessary for ongoing operations. And I look at this because the rescue capital that we're looking at putting in, you have to have a good operator, somebody who is what we call the mensch. They got to pass the mensch factor in terms of being good guys and good people. And then number two, we have to have enough capital to be able to service the senior. And three, we really have to have a good handle on the capital obligations at the property, because if you have to start funding negative capital or additional capital to serve, not only to service the senior, but to be able to carry the property, it becomes certain funds aren't going to be able to do that. So it's not a panacea for everybody. It's a space that requires a lot of expertise.
Yeah, and you can get yourself in trouble, in that world, pretty quick, because, the other thing too is some of these guys, they want to be able to get out of this pref equity in 5 years, and there's no guarantee. I mean, you're basically replacing a senior debt model, and I'm talking about those deals where they took 75% or 80% of cost via a debt fund, and you're replacing it at maturity with a senior loan and a pref equity structure that takes it out. So yeah, you kick the can down the road, but you're basically in the same spot with more expensive debt when you have the weighted cost of capital, across the pref and the senior. And as rates go up, the proportion of the senior debt to the pref piece that you need skews more towards the pref, which puts pressure on everything again. So all great points. I tread lightly when in the pref equity space.
One other, just wanted to get the panel's perspective on the construction lending environment. Obviously, with construction costs where they are, interest rates where they are, many new deals aren't penciling. We still have a number of clients who have good projects in like the Inland Empire, for example, on industrial, and the construction lending environment is so challenging, both for the community banks as well as the larger Big Four banks. So any comments on the construction lending environment, and are you seeing any other kind of financing source like a debt fund take the place of a traditional construction lending bank?
Yeah, I mean, I'll take a stab. So I mentioned that the commercial banks are pulling back. You've been reading about some of the proposed regulatory changes. So they've pulled back. The insurance companies have pulled back. And so the only backfill here is the smaller, maybe some smaller regional banks, debt funds, what have you. The problem is it's really a math issue. And that is, do you want to build industrial at between 6 and 7 return on cost, borrow at 8 to 9, and then hope to sell at a 5 question mark in a world where the 10-year treasury is 5. So the problem is it's obviously a tight credit environment for construction, but does the math even really work? And what I mean by that is, are you getting sufficiently high enough equity returns to justify the risk associated with developing, or would you simply be better off taking those dollars and putting them in to some other alternative investment? So, because if you kind of look across the asset classes, do we need more multifamily? Probably not. There's always an isolated opportunity. Same thing in industrial with retail. Probably we don't need that much more retail, although maybe in the Sun Belt, convenience retail, that actually has pretty good fundamentals. Hospitality, forget it. Alternatives, maybe data centers, life sciences overbuilt, storage is getting soft. And then you come to office, and we clearly don't need any more of that. So maybe the bigger question is, assuming that the math worked, do we even need more supply?
Yeah, and if you can get beyond that, which is hard to get through, because I think Bob's 100% correct on that one. If you do go to get a loan from a regional bank, they're going to require deposits. They're going to require recourse. That recourse is going to be much tougher than it was before. So it's challenging unless you have a project where you have an incredibly low basis that can support that. So it's a big issue.
Yeah, agreed. We're not seeing much in the way of any new product, certainly in the multifamily space. Breaking ground right now. I mean, everything that's being built got done before the bank crunch earlier in the year, and the banks have really pulled back since then. And like Stan said, if they'll do a loan, it's going to be probably 10% lower in leverage, tougher recourse, and no negotiating. They want the deposits. You could get away with not moving your deposits. The recourse was light or non-existent, and you could get a 65% construction loan. Well, all of those things are gone now. And to Bob's point, it's really market specific in terms of whether do we need more multifamily. I think everybody agrees we don't need more office. Targeted retail. I can't speak intelligently enough about the industrial market to make a comment there. But for apartments, for example, markets that have just boomed the last few years, like Nashville, they have so much new supply coming on. We're gonna see pockets of oversupply in multifamily, and then in other markets, you could argue that we're definitely underhoused. A lot of California, we don't have enough housing, but it's so expensive to build right now. New deals aren't coming out of the ground.
Yeah, I think this is the existential issue facing multifamily today. It is that there's a lack of affordable housing for people who are the renter by necessity, as opposed to the renter by choice. And the only thing we have been building as a practical matter is renter by choice product, which is at a high basis. and the rent structure of that just doesn't work. And the implications of this for those of us who live in blue states and blue cities is going to be a political, have political ramifications that create greater risk to our industry than other areas, which is rent control, limitations on landlord rights, which are going to be extremely detrimental to support further development of housing in the areas that need it the most. So it's a triple-edged sword. It's not even double-edged. I mean, we need housing. We got to figure a way to be able to provide it. But then on the same vein, we're looking at 20% rent growth in 2019 and 20 in Phoenix. And then based on that, we use our research to support new construction. And then we wind up with this boom in housing that can't be absorbed.
Yeah, the political risks for multifamily are huge. And, you know, we've got our friend down in LA has qualified a statewide rent control measure for the third consecutive election again. So, you know, the industry is already, you know, getting ready to marshal resources to fight that. But it shows you the extent of the problem, but that solution would be crushing for housing supply in this state and frankly for attracting investment. So, you know, kind of here we go again.
We're going to hit one more polling question, you guys. So, Amy, I'm going to turn it over to you for the next polling question.
All right, thank you. So the third question is, where do you primarily secure your capital from? Institutional equity partners, friends and family equity partners, traditional lenders, debt and mezzanine funds, or other? And then I also, you do have the option to submit questions for the presenters in the Q&A window. We see several coming through, so thank you for that. We're hoping to have time towards the end to address these questions, but if we don't, we will do our best to follow up with you. All right, and here are the results.
Thanks again, Amy. So I think you guys will hit one more question here before we get into Q&A. We're starting to get some questions from the audience, but really has to do with just the distress in the market. What kind of distress are you seeing? Will there be investment opportunities over the next 12 to 24 months? Or as you're looking out over the next 12 to 24 months, are the investment opportunities really not in distress, but elsewhere?
I'll take a stab at that one. So as I mentioned earlier, there's distressed owners and distressed assets. You know, have good asset, bad balance sheet, bad asset, bad balance sheet. Maybe it's a tear down or conversion from office to residential or what have you. And so I think the distress is building by the day, particularly in the office sector. You're all reading about it. There is distress in, for example, Phoenix and Austin multifamily. Hitting on Stan's commentary, one of the nice things about a capitulation in values is the rents go down for office in San Francisco. They go down for rental housing in Austin and Phoenix and elsewhere as the bases get reset. And so I think that's one of the nice things about what I characterize as we're going through a financial rent cycle. And so what happens during a financial rent cycle is the assets come out cheaper. And so that creates more affordability.
Impacts value, but creates affordability.
Yeah, I mean, it's you know, whether it's regulatory like rent control or financial distress, it puts downward pressure on values.
One of the things I think that is important in the conversation here is that I just want to caution everybody with regard to my comments. I'm a long-only real estate investor. I'm not able to tactically allocate and to take my money and to roll it into other alternative strategies, such as, I mean, if I thought oil was going up. So we're long real estate and looking for opportunities in that. And If you are a long-only real estate investor, where you're trying to do is identify the opportunities that exist at that particular moment in time. So the stress that you're seeing today, the most stress is in urban office. That is really the primary stress. But the bigger issue are there alternative uses for that office? I mean, there's been a conversation that's been going on about whether you can convert office into multifamily, and the reality is you can't do it in the urban settings. It's just, A, the zoning laws are not there. B, the structure needs to be really redone. It is very, very, very costly to think about taking an office floor and putting in all new plumbing for bathrooms in every floor and creating a center core. It's really complex. And then when you go into the suburban markets or certain suburban markets like outside of Chicago, where you can have buildings that cost $300 a foot, office buildings that you're going to tear, you can buy them for $20 a foot, $30 a foot, and you're going to tear them down and you're going to convert them into industrial, but they don't even pencil for multifamily. So it's a challenge in terms of figuring out what the alternative uses are going to be.
Stan, let me just comment real quickly. You brought up a very interesting point of it's sort of short-term, long-term. So you're a long-only investor. In my personal life, I'm a long-only investor too. I don't like to pay taxes, so I like to own real estate with recurring cash flows. I invest in convenience retail in Sunbelt markets. It's done very well. The trade outs have been great as a lot of people have migrated to these growth markets. The smartest thing my partner, our partnership did was we secured long-term fixed rate debt. So we have great assets, great balance sheet, and we kept the leverage to a tolerance. And so it's clicking along every month, generating cash flow with ever increasing rents in these markets. And we have no financing challenge in today's market because the cost of debt capital more than doubled, maybe tripled if you did floating rate. So that's a good example of good assets, a good balance sheet. You could have had those same assets we purchased. We could have put short-term debt and we would have had a problem. So, and look at some of the opportunity zones, which are by definition long-term capital. I don't think there's a lot of distress in opportunity zones other than for sponsors that aren't qualified to really be an ozone sponsor, because it's long-term money that has the ability to withstand short-term shocks.
Yeah, absolutely. I mean, the clients that I have that are long-term holders and only use fixed rate financing, they're fine. I mean, do they have some asset management issues here and there? Sure, but they're sure sleeping at night okay. And what we spent early this year and late last year, a lot of the refinances we did then were refinancing borrowers that had shorter term, like agency floaters on their property, and cap costs as the Fed started hiking rates, and the SOFR forward curve just shot through the roof. And, the cost of replacement interest rate caps on these deals, I mean, 10x might even be understating some of the adjustments and the cost of interest rate caps. So getting them out of those and into longer term fixed rate deals, the fundamentals of a lot of these deals are fine. It's just, but if you have short term floating rate financing, you could really be in trouble. And that's where we're seeing the distress in the multifamily world, is when you've got, a maturing floating rate debt that's coming due in the next 6 to 12 months. That's where the distress is. And there will be opportunities if long-term holders are waiting and they got money and they can buy ultimately at a 6 cap, even if they're financing it, at a low 6% rate for 10 years, they feel like long-term there's going to be some good plays.
I just want to make one comment about the fact that all of this, I mean, this is not real estate industry fault. This is a result of an exogenous issue called COVID. We were anticipating a recession starting in 2020 anyway, right after 19. COVID hits, and all of a sudden we have $7 trillion worth of stimulus. And everybody thought that when interest rates dropped down to near zero at 8 basis points, that was the way of the future for the next 10 years. And they financed short-term based upon that thinking, of course, that it was going to continue on. And we all know what that party looks like. It never does that. It always ends when interest rates start to go up. So the net effect is that, as Bob suggested, your strategy, your leverage strategy is as equally important as your investment strategy is with regard to the market and the asset.
We're gonna hop into one last polling question, and then we have a couple good questions we'd like to cover from the audience.
All right, thank you, Chris. So the last poll is, in the next 12 to 24 months, which real estate asset class will have the most opportunity? Multifamily, single family, office, industrial, or none? And we're going to just leave this poll up for a little while Chris starts the Q&A process with the audience.
Yeah, so I think I'll start with this question, you guys. There was a question on just, I think, somewhat related to just how local governments are addressing return to in-person and things of that nature. So it has to do with just how some cities are faring worse than others, depending upon the location. Population growth, obviously there was a migration to the Sun Belt in the post-COVID environment. As we look out over the next few years, any comments on what geographic areas might be attractive for both office and residential as a result of how local governments are addressing return to in-person and population growth?
Yeah, I'll maybe answer first. So at our investor conference, I gave a presentation on trends, and the trends of migration is certainly one of them. And I think you have to distinguish between short-term and long-term migration. So short-term is people that went to Boise and now they're getting called back to go back to Amazon or Google or what have you. That is happening. We're seeing, for example, in New York City, the apartment market is very strong because people have been called back to the office, and there's a lot of FIRE sectors there, more office occupying types of jobs. San Francisco is obviously a bit different. But I do think the longer term trend is to migrate to areas that are more affordable. And that I don't think that's been going on my entire life. I mean, there's all kinds of companies that have started in the Silicon Valley, San Francisco Bay Area where I live, and they end up in other parts of the world, primarily because they need to lower their cost of capital, access labor. And with the internet and cloud computing, you're now able to tap labor in other parts of the world, forget other parts of the US. So I think that longer term trend remains in place.
Yeah, I couldn't agree more. I mean, I just think you're going to see a continued population draw to communities that have lower cost of living, where companies are moving because of the lower cost of living for their employees and bringing jobs with them, maybe a friendlier government and policy environment. And I think you're just going to continue to see long-term that migration pattern continue. And I don't see anything that would stop it. And especially what'll be interesting to see is the current trend of like, especially out in the West Coast between LA and San Francisco, where there's been kind of an exodus from the urban cores. Does that continue, or does that bounce back? I mean, that'll be really interesting to see how that plays out.
That's a long-term answer, because the suburbs are infinitely safer. Families want security. If you look at the office market in Los Angeles, the strongest market is Century City, which is a confined space, which is secure. It's not downtown. It's not other areas. So you have to differentiate it. The one thing I would just caution all of us as we think about migration is the fact that the greatest impediment that is going to occur is resiliency, because of the lack of water, the lack of utilities, the lack of infrastructure, the inability to be able to get power. I mean, even in Texas, where everybody is going, the ability to be able to have a grid that is going to be supportable of all of the new people are moving in is being questioned even by the state of Texas right now and the grid system. So it's something that we need to think about and has to be quantified. So resiliency is a very big factor that is a risk that we all have to manage around.
Stan, you make a great point. There's a study that shows most of the migration is going to areas that can least withstand it. They don't have the resiliency. You all saw what the temperatures were like in Texas this summer. I can tell you from my perspective, I sit in California, which is obviously a high tax state, high cost of operating. I always joke, taxes are quarterly, bugs, heat, and humidity are daily. So I'm staying.
And by the way, those people that I know who are tax migrants who went down to Texas, they spent the summer down there and they turn around and they say, I'm coming back.
Yeah.
So,
by the way, they have to buy a second home because you can't live there full time.
That's true.
Yeah, there's something keeping all of us here in California. I mean, it's as badly as
look out your window.
Exactly.
Hey, you guys, I'd like to thank everyone in the audience for joining us, and then Bob, Jeff, Stan, thanks very much for being on the panel today. Really appreciated all your comments on the state of the market. So thank you very much. Amy, I'm going to go ahead and turn it over to you to close this out.
All right. Well, yes, thank you all for a great discussion today. And to our audience, thank you for joining our fourth session of the 2023 Virtual Building Opportunity Conference. We hope to see you at the final session on November 9th, which is Sustainability in the Built World. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks as well. Finally, here's a link to an online survey for today's presentation. Your feedback is always appreciated, and take care, everyone. Thank you.
Thank you.
Thank you.
Thanks all.
Thank you.